Good morning and welcome to Financial Accounting. We are going to be finishing up chapter 11 today. We will pick up with exercise 5. We have quite a few exercises to get through, but some of them are shorter than others, and we already have all of that foundational stuff built from last class. And so we'll see in another hour and a half, but we should be able to still finish on schedule. Fingers crossed, things go well. So assuming we finish chapter 11 today, the chapter 11 exercises should be submitted by the end of the day today. And then the chapter problem will be due our next class date on Tuesday. You can see that there's an extra credit problem there as well. So there are actually, we've talked about on Tuesday, this past Tuesday, we talked about issuing bonds at a discount. Today, we're going to look at kind of the opposite situation where we issue bonds at a premium. There was not a problem that I liked that combined both of those two things into the same problem, but I still wanted you the opportunity to practice on your own with both of those. And so there are actually two problems for chapter 11. One that is bonds issued at a discount, the other one which is bonds issued at a premium. And the premium one is the one that I labeled as extra credit. So you can just do one of them. If you're going to do one of them, do the one that's not labeled as extra credit. That would count against you if you didn't do it. But I would encourage you, even if you're looking at your grade saying, I don't need the extra credit, I would still encourage you to do that extra credit problem because it is a skill that could, you can expect to see on the exam. So I don't want to mislead you with that extra credit as if it's something that, I don't really need to know how to do this, because you kind of still do. So I would encourage you, even if you don't need the points for your grade, that you still do that extra credit problem. I just didn't have a way of combining them, and I didn't want to require two problems because that's not how I do things. Give me 1 second here to make a note so I don't forget after class to do something. Okay. And so next week, as you know, we'll be covering chapter 12. The chapter 11 problem or problems are due on Tuesday, and that's the end of our work for exam number 4. Exam 4, as you know, covers only chapters 10 and 11. So we'll be talking about that exam next week, unless time allows today, but I'm expecting next week. We'll look at the practice set. We'll look at the exam like we always do. Told you on Tuesday, reminded you that there is a review session scheduled for next Wednesday morning, 9:30 to 10:30. Just like the last one. I would encourage you, if you're free, to sign up on Starfish and join us for that review session. And I do already have a couple people signed up, so I would anticipate that review session will happen. So I would record that. As long as someone's there, I will record it and post that recording after, by Wednesday afternoon, probably of next week. Next week, then we'll cover chapter 12, which is not on the exam. The exam, as you know, is due the Sunday before Thanksgiving. So I think if you look at the JCC calendar, officially break starts Monday morning. So you have all of Thanksgiving week open, or free on vacation or on break. So I feel comfortable having that exam actually be due on Sunday, even though presumably most of you will already be considering yourself on break at that time. If you are going to be gone, if you want to be able to say, I'm done with accounting for the whole week, you should feel free to take that exam anytime after you turn in the chapter 11 problems. So last class, we spent a good deal of the class talking about how bonds work. We went through most of the life cycle of bonds. We talked about why a company would issue bonds. It's the primary way of raising financial capital through issuing debt for a corporation. And we talked about the the difference, the different terminology, the difference between the interest rate that we agree to pay, that face or stated or coupon interest rate, and the effective interest rate, that is the market rate for bonds of a similar risk at the time that our bonds are issued. We talked about face value, and we talked about selling bonds at a discount or premium. I showed you how to calculate a bond price, even though we didn't have that in an exercise yet. And we issued bonds. We recorded those bond issuance. We recorded interest payments using the straight line method when the bonds were issued at a discount. And today we are going to pick up with exercise 5 in chapter 11. And we're going to be looking at the end of the life cycle of these bonds. We talked about the very last thing we did was at the end of class was talking about how bond prices are figured. We've talked about the inverse relationship between bond prices and interest rates. So we know if interest rates are going up, bond prices are falling, and vice versa. So we said that sometimes bonds are allowed to hang out there until they mature. And at that point, we repay the full face value with that final interest payment. But we also said there might be some reasons that businesses, companies who have issued bonds may not want to let them linger until they mature. They may want to retire them early. Excuse me. And it was in that context that we talked about the price of a bond, because we said that some bonds have a feature that they are callable. So a callable bond is one that the company can at any time buy back at a preset price. And that's why we needed to talk about the prices of bonds. You can see in this exercise, it gives us the price of 102. Based on what we talked about at the end of class on Tuesday, you should recognize that what that means is they pay 102% of the face value to get those bonds back, to retire them. Again, we talked about on Tuesday a couple reasons that companies might choose to call a bond issue so that they don't have to keep paying the interest on that bond. Maybe they have some excess cash, they don't have any other productive use for it. And so they think, why not pay down our debt? The same thing that an individual might do if they have debt outstanding and don't have something else that's a better use for that money. Excuse me, they might pay down their debt earlier than the schedule would require. Any questions about anything we looked at or talked about last class? We only did exercises 2, 3, and 4 together. Talking about issuing bonds at a premium, issuing them at a discount, using the straight line method for amortizing the premium or discount. Actually, our first exercise on Tuesday had us issuing bonds at face value, which is a lot simpler, but also not very realistic, not very common. Everybody okay with what we've done so far? Remember also, there are those 2 pages in Brightspace in the chapter 11 reference materials folder that show you the terms and the formulas that will be helpful for you. We use those formulas on Tuesday, and I want to remind you that they're there. The title of this exercise says we're going to be doing entries for issuing and calling bonds, and these bonds are going to be called at a loss. Obviously, then it leads you to believe that you could also call bonds and have a gain reported. So we're going to see what the loss looks like in just a few minutes here. Hoover Corporation, a wholesaler of music equipment, issued $10 million of 20-year 5% callable bonds on March 1st, 2022 at their face amount. So they're making this again a little easier for us. We already know how to handle premiums and discounts. So in this exercise, we don't have to deal with that premium and discount amortization. Again, we issued these bonds on March 1st, which happens to be the first day of the new interest period. So makes it a little simpler. We owe the full 6 months of interest. at the time that the first interest payment is due on September 1st. The fiscal year for this company ends on December 31st with the calendar year. So just to remind you of some of the terminology that we talked about on Tuesday, $10 million would be the face value of these bonds. 20 years would be the duration or the maturity length of these bonds. 5% is the stated interest rate or the coupon rate. Not all bonds are callable. If you purchase a bond that is callable, you would know that it is callable. It's part of the indenture or the bond contract that the company has a preset price that they are entitled to buy back that bond. So the call price would almost always be at a premium, and it really acts as a cap on the upside for the price of those bonds. This company in this exercise has the right, the legal right, to compel the bond owners to sell it back to them at 102 or 102% of the face value at any time for any reason. They have the right to buy it back at 102. So think about it. If you were a bond purchaser, if you were an investor and you were looking at bonds, would you ever pay more than 102 as the price of that bond when you know that at any time the company can come in and say, here's your 102% of face value? But wait a minute, I paid 104 for it. Okay, why did you do that? We have a right to buy it back at 102. So it really acts as a cap on the upside or the growth potential of the price of those bonds. To remind you from Tuesday, why would bond prices be going up in the first place? Because interest rates are falling. But the price on this bond would likely not rise above that call price. It wouldn't be in the interest of the bondholder to buy that bond and pay more than it's actually worth. So the first thing that we are asked to report here is on March 1st when we issued the bonds, and we issued them at their face amount. So you should be able to do this one on your own. They sold them for their face value. And so, of course, anytime we are selling bonds, we are in this case, we're issuing them for cash. I don't mean to imply we couldn't ever issue them for something other than cash. But in this case, we're issuing them for cash. So we need to show that we have that cash and we have an obligation, a liability to repay that $10 million in 20 years when they mature. You also should be able to do the next entry on your own, paying the interest, semi-annual interest on those bonds. So go ahead and do that calculation and do that entry. I'm going to put mine on the screen. You can check yourself. So I found interest of $250,000 using the simple interest formula that we learned back in chapter 8. And since there was no premium or discount on these bonds, the interest expense that we report is exactly the same as the interest that we pay. we saw in the previous two exercises on Tuesday, what the difference or what it would look like if we had a discount or premium that we were amortizing. That discount or premium would be amortized in a straight line fashion, because that's the only approach you're required to know for this class. And that discount or premium amortization would be the difference between the interest we pay and the interest expense that we report. So any questions about that up to this point? So we make the first interest payment, and we would continue to make those same interest payments every 6 months, March 1st, September 1st. And we get to 2024, and for some reason, the company is going to call those bonds in. They're willing to pay 102 for those bonds. So keep in mind that bond interest prices rise when interest rates are falling. If we're assuming that prices are rising right now and interest rates are falling, one reason that the company may want to issue these bonds, or excuse me, retire these bonds, is maybe they want to reissue bonds that are going to be less costly for them, that the interest rate is now lower. And so it's just like refinancing. If you have a home that you got a mortgage when interest rates were higher or something like that. This is September 1st of 2024, and it is an interest payment date, but the exercise asks us or tells us we can ignore that. We don't have to report that final interest payment, but I would just want to point out that we would be required to pay that final interest payment. And if this transaction of calling the bonds happened on July 1st, we'd have to pay a partial interest payment. So the interest that had accrued since the last interest payment of March, we would still have to pay. So that would be 5 of the 6 months, or did I say July 1st? If it happened on July 1st, we'd have to pay 4 months worth of interest at the same time that we were calling in the bonds. So we talked about bond pricing last time. We know that the price of the bonds is expressed as an index, or what I refer to as a percent without the percent sign. So if these bonds with a $10 million face value are called at a price of 102, what that means is 102% of the face value. So if we do the face value of 10 million times 102%, how much would they need to pay to retire all of those bonds? 10,200,000. They're paying a $200,000 premium to retire those bonds. And so the cash that we spend to retire those bonds, $10,200,000. What else happens though? We have a bonds payable on our books for $10 million, but we're paying that back right now, so we can take that part off our books. We want to get rid of that bonds payable long-term liability. We know we can't be done because the debits and credits aren't equal. We need a $200,000 debit for something. What is really happening here? The company's recording a loss on the retirement of these bonds. How do we know it's a loss? Because we paid more, $10,200,000. We paid more than what the liability showed on our balance sheet. Does that mean it's a bad plan for the company? No, because they've just paid for 2.5 years. I'd have to go back and count 2.5 years maybe of interest payments. They were going to make those same interest payments for 20 years. They just saved 17.5 years maybe of interest payments of $250,000 each. So it's maybe a pretty good deal that they had the cash available to retire these bonds early and avoid another 17 years of paying interest at $250,000 each time. So that loss that we recorded on the redemption of the bonds, I assume is based on sound business decision-making. That this is actually saving them money in the long run. But it still needs to be shown on our income statement as a reduction in our income. But it will show up later because as an increase essentially in our income as we save the recording of all of that interest expense over the next 17 years. All right, does that make sense? Green check marks. And so that's how we would record it for a callable bond. Well, what if the company wanted to retire these bonds, but they were not callable? Because not every bond is callable. What would happen if we did not have that call provision in there? Does that mean we can't retire them early? No, it does not mean that at all. What it means is we'd have to pay the prevailing market price. Whatever the price is in the market, if we want to buy those bonds back on the open market, we can do that. We would probably want to be a little quiet about it if possible, because if word gets out that we are interested in buying back our own bonds, what's going to happen? People will start, requiring a higher price, a premium for them. I think there's something a little bit unrealistic in this particular exercise. I wish they had phrased it differently. Rather than say they called the bond issue at 97 as they indicate here on November 1st. I don't think it's realistic to think the call price would be less than the face value. I would prefer that they had just said they bought them back at a price of 97. So what would make the price of bonds fall? Rising interest rates. So if the price is falling, a company might decide to buy back those bonds when they can get them at a lower price. Again, I just take issue with the idea that these could possibly be callable at less than their face value, because look at this. They were sold at their face amount. Their bond purchasers, investors just spent $22 million on these bonds. This exercise would have us believe that the very next day, the company could turn around and buy them back at something less than that. Well, why would you ever buy them if there's a guaranteed provision that the company can give you back the next day less than what you paid for them? That does not sound to me like a worthwhile investment. So I'm going to, for my own purposes, I'm just going to pretend as if it doesn't say they called these bonds. I'm going to just say they bought them back at 97, because that makes a lot more sense to me. But again, this exercise is kind of the reverse of what we saw in the last exercise. We are going to, you can tell by the title of this exercise, we are looking at a situation where they're calling the bonds and they're going to be recording a gain. Mia Breen Corporation produces and sells wind energy driven engines. To finance its operations, Mia Breen issued $22 million of 20-year 4% callable bonds on May 1st of 2025 or 2015 at their face amount, with interest payable on May 1st and November 1st. So again, they've made this easy for us, telling us that they sold them at their face value or at par, and that we sold them all on the first day of the interest period. The fiscal year for the company is the calendar year. Journalize the entries to record the following transactions. I'm going to ask you to do the first two entries on your own, just like I did for the previous exercise. I'm actually going to pause the recording this time and allow you to do those first two entries and then restart the recording, and we'll do the November 1st entry together. If you want to try that on your own before you restart the recording, feel free to do that. I'm going to pause now. Okay, so I recorded the issuance of the bonds and then the first interest payment. Again, just like in the previous exercise, we assume that they continue to make that same interest payment every 6 months. And then in 2019, they decide to call the bond issue. So you may have already tried this on your own. The cash that they're going to spend then is 97% of the face value. So I can show you that calculation. So the face value is 22 million. Oops. And we're going to pay 97% of that, assuming the very unrealistic case that the call price is less than the face value. And I hope everybody can see why it wouldn't make sense to think that somebody would buy something for $22 million when they can be compelled the very next day to sell it for $21,340,000. Why would you do that? But it is realistic to think that within, what is this, 4.5 years, 4.5 years later, that interest rates have increased. And so the price of the bond has fallen to 97 on the open market. And the company might say, hey, let's do that. We can take our $22 million in bonds. We can buy them back for $21,340,000. The difference between those, $660,000, represents a gain on the retirement of these bonds. Whoops, click the wrong one. There you go. Represents a gain. Not only did they save $660,000 in nominal terms, not only did they save $660,000 by buying these back, these were 20-year bonds. And at this point, they've only been outstanding for about 4.5 years. We just saved 31 interest payments of $440,000 spread out over the next 15, 16 years. And we saved $660,000 on the face value of the bonds. If you have the cash available and you don't have something else that's a better use of those funds, makes sense. Don't let the cash sit in the bank when we have this liability outstanding. And so we're going to record a gain. Plus, over the next 15.5 years, we won't be showing that interest expense either. Any questions about that exercise? All right. We will keep going then. Let me share my screen here for a moment. Exercise 7, our next exercise is about reporting bonds. And so I just want to remind you some of what's here, maybe all of this, we talked about already on Tuesday, but because it's relevant for this next exercise, I wanted to make sure that you have this fresh in your mind. So bonds payable, of course, are a liability. Most bonds that are going to be issued by a corporation are going to start out as long-term liability. And so if this bond is a 20-year bond, for 19 of those 20 years, it's a long-term liability. And in the 20th year, it becomes a current liability, assuming that we're going to use current assets to pay for it. The remaining premium or discount that has not been amortized is going to affect the carrying value of those bonds. And so just like we have the carrying value of a long-term asset like property, plant, and equipment, the bonds also have a carrying value. And the carrying value would be the net amount that's showing on our balance sheet as the liability. We know from what we saw last class that the premium has a credit balance, and so it increases the carrying value. It would be added to the face value of the bonds to find the carrying value that's showing on our balance sheet at any given time. And the opposite is true for a discount. A discount has a normal debit balance. It nets against the credit balance in the bonds payable and reduces the carrying value. Over time, as we are amortizing away that premium or discount, the carrying value is approaching the face value. So the discount gets smaller, the carrying value increases. When we make that final interest payment, the discount or premium has been fully amortized and it's down to zero, what that means. And the carrying value is the face value, and that's how much we have to repay to the bondholders. The last bullet point on this screen says a description of the bonds should also be reported either on the face of the financial statements or in the accompanying notes. I showed you last week where to find that in the notes to the financial statements, that you would have a table, generally a listing of all of the bond issues that are out there and the relevant interest rates and the maturity dates as well. Questions on any of that? All right, let's go to that exercise then. At the beginning of the current year, 2 bond issues, Simmons Industries, 7% 20-year bonds, and Hunter Corporation, 8% 10-year bonds were outstanding. During the year, the Simmons Industries bonds were redeemed, and a significant loss on the redemption of bonds was reported on the income statement as part of operating income. We just saw in our first exercise today, in exercise 5, how that might happen. At the end of the year, the Hunter bonds were reported as a non-current liability. In other words, if these are 10-year bonds, we're not in year 10, right? We're in somewhere in year 1 through 9. The maturity date on the Hunter bonds was early in the following year. Okay, so last year, actually, at the end of the year, they were reported as a non-current liability, and that's the current year. I'm just trying to make sure I understand what they're saying here, because there's 2 different reasons it could be reported as a non-current liability. I make sure I have my year references right here. So if they're due next year, last year they would have been reported as non-current. This year, if they're due early next year, this year they should be reported as a current liability unless we have a fund set aside to pay for them. If that fund is not a current asset, remember by our definition, current liabilities we expect to pay using current assets. So if we did have that bond sinking fund, and I know I talked about that, but it's been a few weeks. A bond sinking fund is set aside or set up, established when the bond covenant, the indenture, the contract says you have to be putting money aside so that when these bonds come due, you have the money available to pay for it. We call it a bond sinking fund because it's designed to pay off or sink those bonds at the end of their useful life, at the end of their maturity. And so I was trying to establish what exactly they're referencing here at the end of the year. And I think what they mean by that is at the end of the previous year. So they were a non-current liability, but now they're due early in the next year, so they become a current liability at that point. Unless there's that bond sinking fund, it doesn't tell us anything about that. The loss on redemption of the Simmons Industries bonds should be reported as. So where does this show up? On the corporate income statement, we have the main part, the majority of the income is going to be in what we call above the line income or operating income. But there are some items that are considered what we refer to as below the line. It's not considered part of current operations. And so those below the line items would include extraordinary items. So it might be a loss that wasn't covered by insurance. That's something that's a unique, presumably one-time occurrence. We don't want it to show up in our operating income because why do we do these financial statements? To provide information to decision makers. We don't want decision makers looking at that unreimbursed loss because we had, a hurricane that damaged our business and it wasn't covered by insurance or whatever. We don't want a decision maker looking at that and thinking, well, that's going to happen every year. If it's extraordinary, it means it's unusual, infrequently occurring, and is not considered part of operating income. The other things that might be in the non-operating section of a corporate income statement include things like discontinued operations. So maybe they have a segment or product line, a location that they're shutting down or selling off. It's no longer part of their ongoing plans. That's considered below the line, discontinued operations. Another item that would be considered below the line or non-operating is if there's a change to the accounting requirements, a change to GAAP, that a company had to restate their financials to comply with the new requirement. It's not a change to their actual operations. It's not something that's going to happen again, but they can report that. It has to be reported, but they can report it as non-operating as well. This really is part of operations, though. They made the decision to retire these bonds early and to take a loss at doing that. And so it would be reported as other revenue and expense. Interest income, interest expense, this type of gains and loss on operations are all part of the other revenue and expenses, but they are part of operations. So I told you some of the exercises were quicker than others. Any questions on that about how bonds are reported? You'd see the full carrying value, the bond payable, the face amount plus any premium or minus any discount on the liabilities. They become a current liability once they're due within 1 year, and if we are using current assets to pay for them, to retire those bonds. I want to, at this point, jump back to exercise 1. So we had skipped exercise 1. On Tuesday, and I told you we'd come back to it at the end of the chapter. So now is a good time to do that. I already reminded you just a minute ago why we do all this accounting stuff in the first place, and that is to help decision makers make a decision, some decision about our company. Well, if you are thinking of lending money to the company, if you are thinking of investing in the company, one of the deciding factors for you is going to be, how risky is this company? How risky are they? If you are lending money to a company, you want to know what's an appropriate interest rate to charge them based on their risk. Just like with individuals, you have kind of a credit score. I told you on Tuesday that bond issuances by private companies as well as by governments, bonds are rated. There are a few very well-known rating agencies, including Moody's and Standard & Poor's, that rates bond issues by governments and by private companies. And that really is an evaluation of the risk of the company. What we're going to be looking at in exercise 1 in our exercise set is one way of evaluating the riskiness of the company. And the exercise 1, is times interest earned. So just like much of the financial analysis tools that we've used so far this semester, times interest earned is a ratio, and it is looking at how many times our income is that of the interest. I'll show you the formula in just a moment. We've talked about some standards of comparison. And you can see on here the general rule of thumb for a times interest earned value. Anything less than 1 is very suspect, that we are concerned that that company is not going to be able to make their interest payments. Does that mean automatically if your times interest earned goes below 1 that you are defaulting on your loans? Of course not. But it's a red flag, at least a yellow or orange flag that, hey, this is something we need to look at. Why is this company's times interest earned ratio so low? The higher the value, the less risky that investment would be. And all else equal, the higher that bond rating would be. And the lower interest rate that you would demand on that particular bond issue because of the lower level of risk. Whoops. Okay. So the formula for times interest earned, you can see right over here on the left-hand edge. So the numerator is income before income tax expense plus interest. So income before income tax expense plus interest. We actually have a special acronym for that in finance. Excuse me, I'm going to put that on the screen right now. In finance, we refer to that as EBIT, which stands for earnings before interest and taxes. So the numerator of times interest earned is EBIT, earnings before interest and taxes. And then we divide that by the interest expense. So the numerator is EBIT, the denominator is interest expense. And we're going to go to our exercise. Get it to cooperate with me. So we're going to go to the exercise. So which financial statement is going to include the information we need for this exercise, for this calculation? Earnings come from the income statement. Interest expense comes from the income statement. So this calculation is strictly based on information from the income statement. And let's go ahead and do the calculation here for us. So times interest earned is EBIT divided by interest. So for 2019, we'll do that first. The numerator is the income before income tax. That has already included in it the interest expense, and so we need to add back that interest expense. And then the denominator is the interest expense itself. So let me translate this for you. The numerator, $5,540,000 plus the interest expense. This company has $5,984,000 in earnings available to pay the interest. And the interest is only $440,000. So if we divide that, I get a times interest earned of 13.6. The EBIT is almost $6 million. That's what they have available to pay the interest. And the interest is only $440,000. $140,000. They could pay the interest 13.6 times over with the earnings they have available to pay that interest. So remember, our rule of thumb was less than 1, we're concerned. If their times interest earned is 13.6, without any other information, it looks as if that company's pretty safe. Right? They're nowhere near that 1-to-1 ratio that is a concern for us. They have enough income coming in this year to pay their interest 13.6 times over. Make sense? Everybody okay with that? Go ahead and do the calculation for 2018. Try that on your own. And so what do we notice? Well, their earnings were less in 2018. Their interest was also less. But what we're wondering is if their earnings that grew in 2019 grew enough to compensate for. Oops. So we're wondering if their earnings in 2019 grew enough to more than compensate for the increase in the interest. So why would their interest have gone up in 2019? Presumably they borrowed some more money, right? That's why their interest would go up. And so we're wondering if the earnings went up enough to compensate for that extra interest. And what do we think? Is that, so it showed an increase from 12 to 13.6. Is that a good thing? Our last question. Yes, it is a good thing. It is favorable. We have an extra $1.60 in earnings for every $1 extra in interest. That's the difference between those two. An extra $1.60 in earnings to cover each extra $1 in interest. So that's a safer position. The company's times interest earned did increase. Based just on this single calculation, we would say the company's less risky this year than they were last year. So remember, again, we talked about those standards of comparison. We have that for this, we have that rule of thumb of 1.0 as kind of the bright line in the sand. We definitely don't want to be below that, but higher is better, at least as in terms of the riskiness of their debt. Okay, any questions? Okay. So we are now going to go back to exercise 8. And I need to show you one thing in your textbook. So remember, I told you on Tuesday that this part of the chapter is the appendix, the first appendix to the chapter. The second appendix, you're not responsible for. That is the effective interest method for amortizing premiums or discounts. You do not need to cover that. We're not covering it in class. It's not going to be on your exercise. It's not in the exercises, the problems, the exam. So you're not responsible for that. But this part you are responsible for, even though it is from Appendix 1. And it's related to present value calculations. So I already talked about this concept on Tuesday when I was explaining how a company would decide, do we want to make this investment in the first place? So why would we be borrowing money? Well, we would borrowing money because we have a productive use for it. How do we know if it's a productive use? We have forecasted that, hey, this project or whatever that we're thinking of doing is going to be worthwhile for us. It's going to make enough money that it makes sense for us to borrow money to do this project. It's going to pay off for us in the future. And so what we're going to be talking about then is the present value calculations and how do we do them? What does it mean? How do we do them? So I wanted to show you in our textbook where to find this. So if you were back at, so this is the ebook, right? And if you are back on the table of contents for that ebook, you know, this semester we're going through chapter 14. By the way, as many of you are registering for the spring semester, you'll notice that the textbook is actually 28 chapters. So we're covering 14 this semester. Managerial Accounting Business 1520 covers chapters 15 through 28. When you are registering for spring, I would encourage you to sign up for Managerial Accounting if you're a business major. It is a required course, and I am just telling you, it's much easier to take them back to back because this class is a prerequisite for Managerial Accounting. You don't need to remember every single thing from financial accounting to succeed in managerial accounting, but you do need to remember the fundamentals, the basics. And you know, history tells me that if you take time off, you tend to forget some of even the integral parts, and it is more difficult to have a big break in between financial and managerial. If you're a business major, you have to take both classes. So I would encourage you to register for managerial for the spring. Because you all bought a subscription to Cengage Unlimited for this semester, as I assume you know, that Cengage Unlimited subscription was a 4-month subscription. So it's enough for this semester, and it gave you access to, you know, thousands of books. And so maybe some of you were able to use that to get a book for another class this semester without having to pay extra for it because it was included in that subscription. Your subscription for this class was set up to be a 2-semester subscription. And so you do not need to buy another subscription for managerial accounting, whether you have me for this class or not. So you guys are on-campus students, at least those of you who are here live. You are on-campus students. I assume then that you will sign up probably for managerial accounting on campus, and I will not be the instructor for that, as you know. But whoever you have for that, and I can't tell you right this minute who that will be, but whoever you have for that class, your subscription will still work because your subscription is tied to the way my class was set up as a 2-semester course. And as long as you're still using this book, which you will be, the 16th edition of Financial and Managerial by Warren, your subscription will still work. It will not work for those other thousands of books, but it will work for your accounting class. So in the spring, you will not need to buy any new materials for managerial accounting. So there's my pitch for making it easier on yourself. Take the 2 classes back to back. You won't even need to buy a textbook or the access to CNOW. As we're looking then at this table of contents from the ebook, I'm just clicking on Appendix A. And the tables that you see here in Appendix A are for calculating present value. They're called present value tables. If you have a financial calculator, the financial calculator, like a BA2+, a Texas Instruments BA2+, can do these calculations for you as well. For our exercises and on the exam, there's a link. So if I click on this link in exercise 8 that says Exhibit 5, it's going to pop up for me a table. This, what you see on the screen right now, Exhibit 5, is a portion of the tables from the appendix. So for this class, for the exercises, the problems, the exam, you will be provided the tables that you need for that specific problem. But I wanted you to be aware that they're also in your book. I also want to point out that there are two different types of tables. So you'll notice that this one says present value of $1 due in N periods. And there are two of those tables. The reason there are two of those is because their interest rates start at 4 and go up through 13. So it doesn't all fit on one page. This is the second type of table, present value of an ordinary annuity of $1 per period. So we're going to be talking about what that annuity means as we do these next couple exercises. So the tables are at the end of your book, the end of your ebook. The limitation of these tables is that you only have, I pull the whole thing up. How to make that bigger. Scroll over. So the limitation of these tables is that you only have in the tables certain interest rates. So 4, 4.5, 5, 5.5, 6, 6.5, 7. And then the next table starts at 8 and goes in whole numbers, 8, 9, 10, and so on. So we're limited on the usefulness because we have to be relying on one of those set interest rates. You'll notice the number of periods is down the left-hand column of the table, and it goes one period at a time till we get to 35, and then it skips to 40 and to 45. And so if you were looking at a problem, if you were looking at an application that the interest rate was 4.2%, we couldn't use these tables because 4.2% isn't on the table. If you were looking at a number of periods, a number of months or years that was 37, let's say 36. So maybe you're looking at borrowing or investing money for 3 years. It's going to compound monthly. That's 36 periods. 36 months is 3 years. Not on the table. We can't use the table. If you've ever tried to borrow money or invested money at a set interest rate, like in a bank account or in a, some kind of a certificate of deposit, a money market, something like that, is the interest rate ever exactly 4% or 4.5%? No, it's probably like 3.9 or 4.275 or something like that. So these tables have a limited usefulness because we'd have to have a table that showed interest rates out to maybe 2 or 3 decimal places. That's not reasonable to think that every possible combination of interest rates and number of periods would be covered. Excel can do these calculations for you. Excel has built-in functions for present value and future value, and present value for an annuity and future value for an annuity. For our class, as I said, anytime we need them in the exercise or in the problems or on your exam, you'll be given a table that includes the factor that you need. But in the real world, and I hope that you are able to pick up how these types of calculations could be valuable for you in the real world, be useful for you. In the real world, carrying around a set of tables that covers all possible combinations of interest rates and number of periods is just not reasonable. And so you'd want to have either the knowledge of how to use Excel or a financial calculator that can do that for you. Questions at this point? Okay. So let's talk about what present value means. Assume that you are going to receive $50,000 in 10 years. Why would you receive $50,000 in 10 years? I don't know. Maybe you're putting money into an investment and you're told that in 10 years it will be worth $50,000. The current market rate of interest is 4%. We're asked to use the present value table and determine the present value of this amount compounded annually. So to put this in realistic terms, let's just pretend that you know that you'll need $50,000 in 10 years for some purpose. I have no idea what, maybe to make a down payment on a house or to finance some other major purchase in your life. And so you ask the question, well, if I want $50,000 in 10 years, how much would I need to put in the account today if it's going to earn 4% interest compounded annually for the next 10 years? Would you put $50,000 into a bank account today if you were told it's going to be worth $50,000 10 years from now? Would you put 50,000 in today and be happy with it being worth 50,000 10 years from now? No, especially not when interest rates are, pushing 8, 9, 10, 11%, because that $50,000 10 years from now is not going to buy nearly what $50,000 today would buy, right? Okay, so that is the time value of money, what I just described. You would never put $50,000 in an account today to be told it'll be worth exactly the same amount in nominal terms 10 years from now. No, you're putting in the account because you expect it to grow. The present value tables, the present value calculations are, we want $50,000 10 years from now. How much would we need to put in today? What is the present or today's value of that $50,000 10 years from now? These calculations show us how to do that, show us how to put into practical terms what we already know. 50,000 today will be worth more, that should be worth more than 50,000 10 years from now. If we want 50,000 10 years from now, how much would that be worth to us today? How much would we need to put in that account to have it grow at a compound rate of interest of 4%? The formula for the calculation, I'm just going to put the formula here on the screen. To find the present value, we take the future value and we multiply by the present value interest factor. So there's our formula. To find the present value, we take the future value and we multiply by the present value interest factor. And from this point forward, I will abbreviate that because that's just far too long, as PVIF. Present value interest factor. Yesterday, while I was in Olean, I went to get something that I had printed. I went to get it off the printer and I saw someone else's, another professor's printing was sitting there on the printer as well. And it was a worksheet quiz kind of thing for one of the lower level math classes that we offer here at JCC. And it was actually a vocabulary kind of quiz. Factor might have been a word on that quiz. I don't know. I didn't pay that much attention to it. It wasn't mine. Had other things to do. But factor is a vocabulary term from math class. Does anyone remember what factor means? What a factor is in math? If I said to you, what are the factors of 8? Do you know what that means? What are the factors of 15? Do you know what that means? Perfect. So a factor is something you use in a multiplication expression. The factors of 8 are 2, 2, and 2. The factors of 15 are 5 and 3. So when we say that this is a factor, it means something we're going to use in a multiplication expression. We're going to multiply by that factor. And the table, whoops, can't do that. The table represents a bunch of factors, and you just ignore that blue writing across there if you would, please. So the numbers that are in these tables are something we're going to multiply by the future value to find the present value. You'll notice that every single one of these numbers is a fraction. It's less than 1, right? So that tells us, without doing anything, that tells us that the present value of some future cash flow is always going to be less than the future value. We're multiplying by something that's less than 1. Not negative, but less than 1. So in our exercise, what are the critical pieces? To use that table, we need to know 2 pieces of information. We need to know the relevant interest rate. In this exercise, it is 4%. We would call that the discount rate. That's the interest rate that we're going to be using to discount those future cash flows back to present value. So we need to know that, the interest rate, and we need to know the amount of time. We're told that the time period is 10 years, but we need to make sure that the number of periods that we use corresponds with how often this is compounded. In other words, how often is interest added to that account? If interest is added monthly, if it's compounded monthly, our number of periods would need to be number of months. Because we're told this is compounded annually, the number of periods, the N we're going to use is 10 years. And so those are the 2 pieces of information we need to finish this exercise. 4% over 10 years. And so we go to our, sorry, I'm just trying to get my marker up here. We go to the 4% column, and we go down to 10 periods. 4% and 10 periods. What I just boxed in is the factor that we're going to use in that expression. 0.67556. Everyone see how to find that? If it said it was compounded monthly, we would go to the 4%. If it was 4% compounded monthly, I need to be clear on what I'm saying. That would mean the interest rate was 4%. If it's a 4% annual rate, we need to be expressing it in number of years. But if it's 4% compounded monthly, if it's 4% annual rate, but it's compounded monthly, we'd have to change the interest rate into a monthly interest rate. But let's go back to our exercise because we now have that factor, 0.67556. And now you just have to, let me erase those boxes. So let's see if we can do this calculation now. The present value equals the future value. In 10 years, we want $50,000. We went to the table and we found the present value interest factor, 0.67556. If we put $33,778 in that account right now, and it earns 4% annually, compounded annually, at the end of 10 years, we will have the $50,000 that we want or need for whatever purpose. So the answer is $33,778. Why is the present value less than the $50,000 to be received in the future? So I know I mentioned inflation. But that's not the answer to this. The answer is it's the compounding of interest. So in the interest of time, I'm not going to go through the whole thing, but I just want to show you very briefly how another way we could get at that same answer, but it's just a lot more work. I could, if we had time and you had the inclination, Actually, you know what? Give me 1 second here. Let me see if I have. I think I can just quickly show you this. Because I'm just gonna use Excel and it'll be easier. I'll have Excel do the work for me. So if we put 33,000. Bigger. Why can't I make this bigger? There we go. So if we put into an account $33,778, everybody okay with that for our starting point? How about year one? How much interest are they paying? 4%. So it's that times 4%, right? That's the interest we would earn in the first year. And so at the end of the first year, there's the full value of our account, right? But in the second year, so that's how much we have invested. In the second year, just going to pull that formula down. In the second year, we earn 4% interest again. But the reason this is different than what we did in the simple interest formula is now we're not just earning interest on the original 33,778. We're also earning interest on the extra $1,300 that we earned in interest last year. So this year, the interest is more than last year. And so our account has grown more in the second year because of the compounding of that interest, earning interest on the interest. Hey, that was supposed to copy down. So how do we do it for the rest of the years? It's off by 31 cents because of rounding. But you get the idea. Each year, if you look at column C, each year the interest increases a little bit. Even dollars and cents. Each year the interest, the earnings on that account grow because we're making interest on all the interest that has already been earned, as long as we leave that account in there. Make sense? So the formula for this factor, so what did we actually multiply by? Let me just pull up that formula. We multiplied by 4% to find the interest. And so this column is actually 1 plus 4% or 100% of the original amount. Oops, percent plus 4% for interest. Right? That's what we really did. We took the original amount and added 4%. So we have 104%. And we did that 10 times. So thinking of math notation, what did we really do? So we did that 10 times. We could just keep writing the 100% plus the interest rate. So what, if I wanted to change that into math notation, what I really did was take 1 plus the interest rate, just going to call it that I, 1 plus the interest rate, and I multiplied that by itself 10 times. One plus I times itself 10 times. That's what I just did. What does that 10 represent? That's the number of periods, right? The formula for the future value, because I started with the present value of 33,778 and I multiplied it by this factor 1 plus I to the T to get the future value. So the present value is here. The future value in 10 years is here, basically $50,000. This is the formula, 1 plus I to the T. 1 plus the interest rate to the power of the number of compounding periods. So the higher the interest rate, the more the compounding periods, the more growth we get from that present value to the future value. You do not need to know this formula, but I like the idea that you understand why it works and where it comes from. This number is, this formula right here is where those numbers come from in that present value interest factor table that I showed you. Okay. To go from the future value back to the present value. So how did we get from present value to future value? We multiplied. So if we're at the future value, we want to get back to the present value, we would simply divide. And I'm going to close this and show you in the table. Oh, sorry, in this table. At the top of the table right here, it gives you the formula for how those factors are determined. And they use the notation N for the number of periods. I just use T, but it's the same thing, 1 plus I to the N. And we're dividing by that factor rather than multiplying to go from present to future value. Questions, anybody at this point? So you know how to use the present value of $1 due at the end of some number of periods. These first tables are for a single cash flow happening at the end of some number of periods. Our next exercise is present value of an annuity. That's going to be the second two tables. An annuity, the root of that word annuity refers to a year, right? Annual. An annuity is something that happens at the end of each period for a given number of periods. So if you say that you have an investment and you're changing it into an annuity or you're annuitizing it, it means that you're going to take a regular cash flow at the end of each year for some number of years. And that's what we're going to be doing in this exercise. And that's what that's what those second set of tables are used for. If we look at this table compared to the one I just had up, unfortunately, I already closed it. But if you were really looking, the first line when N or the number of periods is 1, this line looks exactly the same. These numbers are exactly the same as what we saw in Exhibit 5 for the last exercise. But the rest of the years, 2 through 10, you'll notice all the numbers are greater than 1. So I pointed out to you on Exhibit 5, all of those values were less than 1. Now they're all greater than 1. That's how, without even the title on the table, you can tell that this is the table, the factors for an annuity, not a single cash flow. So an annuity is a regular cash flow happening more than one time. In this exercise, it says on January 1st, you win $50 million in the state lottery. The $50 million prize will be paid in equal installments of $6,250,000 over 8 years. So $6,250,000 times 8 is $50 million. We receive the full $50 million. However, we don't get it all up front. And so is it really worth $50 million to us today? No, because they aren't handing us all the money today. They're going to give it to us in installments over the 8 years. And the final $6.25 million 8 years from now does not have the same value to us today as $6.25 million would if they handed it to us right now. We all already agreed to that, right? If you have to wait to get it, it's not worth as much to us. Okay. If the current interest rate is 5%, determine the present value of your winnings. And so the formula that we're going to use looks almost identical to what we used in the previous exercise. To find the present value, we take the future value and we multiply by the present value interest factor for the, and I'm just sticking one more letter at the end of that, present value interest factor for the annuity. We use those other tables, the ones where the values, the factors are greater than 1. So one other point, and I don't need to write it on there. One other point is that future value represents the annual cash flow. So we don't use the $50 million, that's the total of the cash flows. We use the single year annuity payment. In this case, $6,250,000. And then we need to go to the table to find the annuity factor. So just like we did with the first table, the first exercise, we need to know how many years or how many periods. In this case, it's 8 payments. And the interest rate is 5%. So if I go to the table, and luckily I don't have blue covering it up. So I go to the 5% column and I go down to 8 years or 8 compounding periods, and there's our factor. 6.4632. 46321. So I don't forget, I'm going to put this in there. 6.46321 is the factor we're going to use from the table. It's greater than 1, but it's not 8, right? There are 8 payments, but we're multiplying by something less than 8 because some of those payments we have to wait, 7 and 8 years to get. And so if we do that calculation, 6.25 million times 6.46321, what do you get for the present value of all those future cash flows? Anyone get a number for that? Just round to the nearest dollar. Or is it? I got 40. Let me just make sure I punched it in right. 6. Yep. So I got 40 million. Yep. 40,395,063. Not quite $50 million. It is a total of $50 million in cash flows, but they're spread out over 8 years. And so in today's dollars, in real terms, that's worth to us just over 40 million. Now the Powerball this week was like what, $1.9 billion. That is also going to be spread out over some number of years, just like this. What's described here is what happens. And I'm pretty sure that 1.9 billion is still going to be a pretty large number, even if you discount it. The higher the interest rate, the less that will be worth for us today. The longer we have to wait to get the cash flow, the less it's worth for us today. Okay, so now we know, we have just a few minutes left to finish up here. Now we know how to use the present value tables for a single cash flow and for an annuity. Any questions up to this point? So in the last 5 minutes here, if we can do this quickly, we're going to see how using this concept of present value relates to what we're talking about in this chapter, which is corporate bonds. So we've talked about the price of bonds and how, and the relationship between interest rates and the bond price, premium and discount and so on. But what we haven't talked about is, yeah, but how does that price actually get established? How do potential investors know how much that's worth? Well, this is how it works. And that's what we're going to be using present value to determine. How much would an investor be willing to spend for a bond? When we talk about bonds, there are two separate cash flow streams associated with them. The first is the principal that's going to be repaid. So in this exercise, it tells us that they issued $25 million in bonds. So what that means is in 5 years, the purchasers of these bonds will be repaid $25 million. So that's one cash flow associated with these bonds. How much is that $25 million payment 5 years from now worth to these investors? Well, that's a single cash flow. We're going to use the tables. Reopen table 5. So we're going to use those tables to determine how much is that worth. It's based on not the interest that the bond is paying, but the market rate of interest. How much is that worth? Well, this is what investors are demanding, 9%, the market rate of interest. And so 9% over 5 years. This is a single cash flow. And I should have done the interest part first. That's okay. I'll just explain it. So that single cash flow of 9% over 5 years, to be consistent. Remember, interest is paid every 6 months, right? Twice a year. So to be consistent between the interest and the principal, we're going to use, rather than 9% over 5 years, we're going to use 10 periods, so every 6 months, and 4.5%. I cut the interest rate in half and used twice as many periods. So right down here at the bottom, 4.5%, 10 periods, the factor is 0.64393. So 25 million times, God bless you, 0.64393. How much is that? So 16,098, 250. So in today's dollars, that $25 million single cash flow 5 years from now is worth 16 million to the investor. That makes sense. Single cash flow, we use the present value interest factor. Okay. Everyone good with that? The other cash flow associated with is the interest. And so the interest that they agreed to pay is 7% annual interest. So the interest payment that they will receive is $1,750,000. They receive that annually. So every 6 months, they receive 30 more seconds and we'll be done with this, I think. $875,000 every 6 months for 5 years. That's a total of 10 interest payments. They're going to receive a total of $87 million in interest. But again, that's not worth $87 million to them today. This is an annuity. Every 6 months, 10 times, they're going to receive an annuity of $875,000 at the effective interest rate of 9%. So if we go to that table for an annuity, it's a half-year payment. So we're going to use 4.5% in 10 periods, just like we did. I said we were being consistent. So just like we did for the single cash flow, we're going to use 4.5% in 10 periods. The factor is 7.91272. 7.91272 times the 875,000. I remembered that number correctly. So the 87 million in cash flows for the interest is worth 69 million. No. 6 million, my comma's in the wrong place. There we go. So that's the value of the interest. The value of the principal we already calculated. If we add those two together, that will tell you the value of this bond issue to the investor. And if I just added those together, right, because I'm trying to hurry, I already 1 minute over. 23 million, 21,880. So these bonds, excuse me, would sell at a discount. They would sell for $23,021,880. If I divide that by the price, the face value, they would have a price of 92. They're selling at a discount. We already knew that because the market rate of interest is 9% and we're only paying 7%. We knew going into this, we wouldn't get the full 25 million, but this is how we would determine how much we actually would receive. And so that's the reason I needed to cover the present value stuff in this chapter. It is how bond prices are established. All right, we're done with the chapter. I'm sorry for keeping you a couple minutes over. See you on Tuesday.
Have a good one.
Same to you. Thanks, Zach.